Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsarthi, and the year end has come, and we are moving into 2023. Just to give a recap of what happened in 2022 and what will happen in 2023, and what should fixed income investors focus on to get the best returns on a risk adjusted basis, and financial advisors looking to uh, give portfolios to their clients for fixed income. Where should the asset allocation happen? Just a recap of 2022. The theme in 2022 was largely safe bonds turned unsafe. And this was particularly waiting to happen. When I mean by safe, which safe mean in terms of credit risk, as in government bonds, AAA rated bonds, and all kinds of products, mutual funds that invest in the highest safety bonds. And all these are turned unsafe. And globally, there's been a massacre in government bond deals. In India, too, it's been a poor year, very poor year for government bonds and say highest safety credits. And this was largely because of the fact that this was an explosion waiting to happen, with central banks keeping rates extremely low in spite of inflationary threats, and continuing to keep bond yields at absurd levels, especially in global markets. And India too, RBI was trying to protect the 10-year GSEC yield at 6% levels, and finding that they could not protect it for a long period of time. And all this clearly drove up inflation expectations. And from extreme accommodation, central banks have become now extremely hawkish, raising rates more and more. And that hawkishness is feeding into markets' nervousness as well, in terms of wondering whether the central banks are being on top of what they're doing, or they're reacting hastily to all kinds of situations, whether it's on the accommodative side or on the hawkish side. So market nervousness leading to reluctance to invest in government bonds. And because of low government bond yields, the highest safety AAA rated corporate bonds, again globally, and in India too, were trading at very low levels of yields. And this has also impacted the returns in the market. And surprisingly enough, in India at least, the best performing bonds have been the lower rated bonds, which is the 2 to 3 year kind of maturity, where the yields have been very, very sticky in a 8 to 10% kind of range. And these bonds have done really well, and in fact have outperformed safe bonds by at least about 5 to 6% in 2022. The question is whether these bond yields, this bond performances will continue, whether safe bonds will make a comeback in 2023. So let's discuss. Now, just giving you a brief of returns. In the 2022 1-year returns, government bonds across maturities, Bharat Bond ETF, 10 years, and even the shorter ones, mutual funds across, from short-term funds, ultra-short funds to long-term funds, all have given returns in a range of just about 2 to 5%. And these have been clearly inflation at 7%. They are clearly underperformed. AAA rated bonds in 2 to 3 year, 2 to 5 year bonds also have given very low levels of yields in a 3 to 5% kind of a range. Whereas, like I mentioned, lower rated bonds, AA, and A, have given very decent returns, because the returns have been very sticky at around 8 to 10% kind of a level. Investors who have clearly invested in, who have moved away from high credit safety, including government bonds, to looking at better credits with the recent returns, have really done well. And in all this market, even equities have done not too well. Just Nifty is given 6%. And it's been a tough year overall for the best the indexes as well as the safer products, whereas other products have given bonds and or even um, equities where they've been stock specific, they have given much better returns. Now, what are the current levels in the market? So let's take a look at it. So 3 to 10 year G-Secs are all in the range of 7 to 7.4%. Bharat Bond ETF have been again very flat curve. 2025 is around 7.5%, whereas 10-year also is around slightly over that levels. SDL yields are 7.6%. You have corporate bonds, 3 to 5 year AAA bonds in a 7.75 to 7.5 to 8.25%. 10-year bonds too are in a 7.85 to 8.25% for the best rated AAA bonds. PSU AAAs are in a range of 7.5 to 7.6% or 65%. So these are the levels in the markets. So funds too have given some, the portfolio yields have gone up. So most of the funds are in a 7% kind of a level in terms of portfolio yields. This is pre-expense ratios. So all this is, these are the levels. The question is, where should the investors look to invest in 2023? So like INR bonds, we have been maintaining that there's still a very uncertain year for the markets, and the best places to get returns to beat inflation as well as protect against uncertainty seems to be the 2 to 3 year kind of maturity bonds in a range of 7.75 for high safety bonds to 9.5 for good credits, but lower rated credits. So if investors can find this kind of yields, then financial advisors too can look to position the clients' portfolios so that they protect against credit risk as well as against uncertainty risk, as well as get enough returns to meet the client's objectives on a risk-adjusted basis. The best places for financial advisors is obviously INR Bonds Partner Portal, where you can get the best bonds to invest in the current in a uncertain interest rate environment, get better returns for your clients, increase your fixed income assets. So see the best bonds with the most information and the easiest of investment processes for clients. INR Bonds is the place for financial advisors. Log into INR Bonds and sign up as partners now and grow your assets in fixed income, because this has definitely been a pain area for investors, and good advice and good portfolios can really help investors and also help advisors in terms of increasing their assets under advice or management. Thank you very much for listening in. In terms of private placements, we have seen 2-year Navi FinServe at 9.9% levels, and we have the AAA corporate bonds in a 3-year in a range of around 7.75 to 8% levels. Also, we have you have IRFC's 10-year bonds in a range of 7.65% in terms of private placements. We should see more companies looking to raise funds in 2023. A lot of exciting things happening in the bond markets in 2023. You have the first is that private placement face value is coming down from 10 lakhs to 1 lakh. So investors with a few lakhs to invest in, or just a lakh or more to invest in, can invest in corporate bonds, good corporate bonds with a variety of choices because of lower face value. Lots of public issues too expected, where face value is rupees 1,000, minimum investment is rupees 10,000, We are expecting the first municipal public issue coming through in terms of indoor municipal corporation. They should all add variety as well as give more options to investors and give good credit, credit levels for good credits for investors to invest in. In other private placements, you have Vivriti doing a 2-year bond at 10.75%. You have LIC Housing Finance doing 3-year bond at 7.82%. Fullerton doing 3-year bonds at 8.4%. And then you have L&T Finance and Tata Capital doing 4 and 5-year bonds at 7.6% levels, respectively. And Kotak Infrastructure doing 6-year bonds at 7.97%. We had some perpetual bonds coming through. Axis Finance, Bank of Maharashtra, and Tata International, all issuing perpetuals at 9.1%, 8.15% for Axis Finance, 8.74% for Bank of Maharashtra, and 9.7% for Tata International, 9.75% for Tata International. So these are the current levels. And 23, like I said, is still an uncertain year. So best investment should be in the 2 to 3 year kind of maturity buckets with good returns if you can find the good credits. And INR bonds is the best place for you. And do not forget to download our app, Quick Invest by INR Bonds, where we have a list of almost 40 to 50 bonds curated especially for your investors and financial advisors to help them take the easiest of investment decisions in bonds from a very large universe of bonds on offer. Download the app now and get the best bonds for you to invest in on a risk-adjusted basis with our own proprietary risk scale and the easiest of in-app investment purchases. Happy New Year to all of you, and look forward to engaging with you next year on Let's Talk Bonds.